Good morning and welcome to today's edition of the London Session Open. Today is March 16, 2020, and it's 9:51 a.m. in London when we're doing this market update. I hope you guys doing well. Hope you guys being safe and everything. Markets very volatile. The Federal Reserve and the New Zealand Central Bank cut interest rates when the market opens, and market did not like that. So they're seeing this as panic and maybe too little too late. At least that's the reaction so far. So we're going to talk about that. We're of course going to talk about the coronavirus because that's the number one reason why we are in this situation, and we're going to give you all the technical analysis that you may need. When I do finish the first part of the presentation, where I'm going to cover euro dollar, GBP, dollar yen, gold, crude, DAX, and the S&P 500. After that, if you have questions, you can just put them here in the chat box, and I'll do my best to try to answer your questions. One question per person as well. Okay, let's take a look a bit at the markets, right? So having some significant volatility, and let me just show you here. So you have the FTSE 100, which is down with and was down with 10% at one point. You have the German DAX, which is down with 10.75%. And then there's no activity in the US 30 and the Nasdaq 100. The reason for that is that this market moved lower than 5%. And when that happens, you hit the limit, which means that trading is halted. And the trading should resume as normal US trading hours start. They're going to open. And then if they decline for more than 7%, they're halted for 15 minutes. And then they open again. And then I think if it's 10%, they're halted for another 10 minutes. And then I think there is another barrier, but I don't remember exactly what that is. I think it's 20 or something, or 15. And then after that, if that limit is hit again, then I think you need to wait until the next day to trade, really. So that is the situation right now. As with the currency markets and then gold and all this, they're pretty much up and down. It's a bit difficult to do something really with some of the currencies because they don't have too strong trends. The only thing with very strong trends is the stock markets, which again continue to trade lower and lower and lower. But it's not easy, and we're going to talk about that. But let's begin with the euro first. So the euro is moving down a bit lower. I mean, I think it made sense. The same way stock markets are going to bounce one day, right? So this is the euro going up and up and up and up and up, rallied by some 725 pips, which effectively took you from sort of the lowest levels so many years back to same levels seen in January 2019. So effectively 2 years of gains here were wiped out in a month or so. And then the market pulled back. It's the same thing with stock markets, I think. Eventually, people are going to say, all right, okay, we're going to get the virus, but, people are going to die, but people still going to be around. And that's when things start to move back up again. So I think the same thing is going to happen. But right now in stock markets, as you know, they're very depressed. And here, from a technical perspective, we're dealing with a bit of a bounce, which makes sense. So because with the Federal Reserve, they cut interest rates to an interval of 0 to 25%. So they pretty much have interest rates at the same level as the New Zealand dollar. And remember, the New Zealand dollar used to be a high-yielding currency. And then you have the euro, which have pretty much interest rates at negative, I think it's negative 50 basis points. Some of the interest rates they have there. They have various interest rates, but around 0 to negative. So there's no huge difference now between holding dollars interest rate-wise and the euro interest rate-wise, and that tends to weaken the dollar as well. The government, so the Federal Reserve, has now made a deal with other 5 major banks like Bank of England, ECB, for example, that if institutions in Europe, they need dollars, instead of going to the market and buy dollars, they can just go to the central bank and get them from there, and the ECB will get whatever they need from the from the Fed. And then of course, when things are done, when there's no demand longer, they push that money back. So that, as well as easing the pressure a bit on the dollar, really. So the dollar is definitely seeing some gains, but not as much, right? So we're going up here, and I think we can probably just use technical analysis for this. So if you're looking at this, you're looking at a big range with no strong trend, and we're closer to the highs than to support. So from that perspective, I'd rather be bearish than bullish. So I'm gonna be bearish from 114.94, and we moved up a bit. I think we can move up a little bit more to maybe 12.78, 113. But from this little space here, effectively below 114, from this little space here, I would assume that we're gonna go lower. So you can actually tighten this up a bit like that. If we go above 114, it's not necessarily mean that we're gonna rally crazy massively higher, but it could be we're just gonna go up and actually touch that, so we can save some 70 pip here on a stop loss. Here's the GBP versus the USD, and the GBP is actually met by several risks, and one risk is actually Brexit, because the situation is here. Because of this now, the Prime Minister and his government is all focused on the situation with the virus as well in Europe. People are all busy with the virus. No one really has time to deal with Brexit. Of course, there's probably negotiations happening, but it's not as full. It's not sort of the main focus. That's one of the reasons. But again, the dollar has been doing quite good against many different currencies. And the difference here as well is that the pound is not a funding currency. So people took bets probably when PM Johnson became elected, and then when they got general election, because in the long run, yeah, of course, if they do cut taxes in the UK, if the liberal make it more easier to do business, then from a business perspective, it's going to be easier to do business in the UK, and you can have higher economic growth as a consequence of that. But now, so people bet on currencies like this. It's the same thing when the world economy is going up, everybody's going to be buying Aussie dollars and New Zealand dollars, right? Because they are exporting nations, they're going to look to make money when things are going good. However, when there's times of crisis, people don't care about making more money on different projects. They take their money, put it in cash, and then they just wait for better times. Of course, at this time, there's probably someone out there that says, hold on, if they get a bad deal, how much lower we're going to go, and if they get a good deal, maybe we'll be up by 130 again. So there's also those people. But for now, what's happening is that people are selling here. And we talked about a break to the downside here, taking you down. Definitely went much faster than I thought it would do. And we're just above the October 2019 low, which means, and which declined quite fast in just a very short period of time. If you look at the daily RSI, we're a bit oversold again. Now, just because we're oversold like here, for example, doesn't mean that we're gonna rally upwards, but it means that we can have a bit of a struggle, a bit of sideways trading for a month or two before things go lower again, potentially, when things are not oversold anymore. So I think that could be sort of what we're looking at. And I think from a sort of trading tactical perspective, we need that little pullback anyway. So the trend defining level is 126.48, and if we swing back up here, 50% move, then that could be something that people might use to sell, and then they try to push this down lower. Okay, dollar yen. I haven't traded this for some time. It's the new pound. So the British pound versus the USD is very famous to give you false breakouts. This one, I think, is trying to take over that role with several breakouts and attempts to trade higher and also attempts to trade lower without really seeing any effect at all. And always tends to reverse. And we talked about, last week when the market gapped and we're trading down here, I said if we close below here, we have that big pattern. And I said if we go up, well, as long as you trade, I think it was below this level here, this area here, we should be bearish. But the market went up, reached the sell zone, and then from here it went down. So we went well for us for a little while, and then it went up, and this whole setup would have failed. This market is now back within that range, and I think it's very, very good idea to ignore this market for now, not do any trading here. I think even in the short term, I sort of struggle to figure out if we should be long or short. Obviously, in the very, very short term, we do have a bit of a bullish trend above this low here. And if we do trade below this low here, then we could have a situation like this, okay? So that is what I would keep an eye on if you want to do anything. Until this happening, might go up a bit, or go down a bit, and then up, and then spend some time effectively here. Let's talk about crude oil prices. So these are crude oil prices down with 9.22%. So we closed a bit of the gap here, but not enough. So we're still dealing with the big slide from here to down here. This market is down with some 60% from its 2020 high. Yeah, 58% at one point. We're still trading above that major low, the 2016 low. Of course, the way things are going, we'll take that out at one point. But trading is always about risk reward. And I think as long as you do trade above the 2016 low, there's a case for this to go upwards. So we could potentially make some money on the back of that. So that's why I'm going to continue to be bullish in the SIL space between 25.93 and 30.18. Okay, let's talk about the German DAX. So this is the German DAX. So I don't remember exactly the levels I shared with you guys on Friday. Let's see if we can pull these out. So this is today. Markets move so much, so if you wonder what I'm doing, I'm just looking for the levels for should be here, but I can't find them now. Alright, we'll skip this for now. What can we say about today then? Well, a bit disappointing without any I mean, definitely disappointing. I think the markets were not able to gain on the big cuts from the Fed. But when things go back to normal, which it will do, remember, interest rates are going to be ultra low. They're doing that QE and it'll continue for longer because a lot of the central banks, they are not forward looking. I mean, they're definitely forward looking, but they will continue to pump money into the system until they see that the market is recuperating. It's recuperated nicely. So when that ever happens, we'll have some decent rally. Probably even have a bit of not inflation because of crude oil going down, but you can have inflation in other stuff, real estate and stuff like that, because suddenly it's like dirty cheap to borrow money again. I mean, it is dirty cheap already, but even cheaper. Now, from a technical point of view here, the situation is really, really clear. It is bearish below 9,989. And if we swing all the way back up, I think we're going to move down. Of course, if you look at it from a contrarian long-term perspective, you're just above this low here from October 2014. The market is down with 38% from its all-time high. And that is pretty much the same as we saw here in 2011. And of course, if this market will continue to trade lower and head to recession, which it probably will do, we probably will go lower. But for the contrarian, there's an opportunity to be bullish just above the October 2014 low. And for people that just want to follow the trend, they're probably going to look for that little corrective move up here. I'm not sure we're going to go all the way up, but that's where I'm looking. Remember, the market closed here on Friday. And maybe when the US opens, they will either try to close the market in the very beginning of the day, or maybe by the end of the day try to close this gap. So that is what I will be watching. For the S&P 500, so it's unchanged here, and the reason for that is because there's a limit down. So outside of normal trading hours in the US, when the markets decline with more than 5%, trading is just halted. It's nothing to do with your broker, it's for everyone. So because the broker, they take the price from the exchange, and then they give that to you. And when it stopped at the exchange, there's nothing we can do here. So that's why there's nothing happening here. And we just need to wait until trading comes back online, which should be in a few hours time. But as long as shit above 24.79, this is going to have a bit of a bullish bias. I do suspect though that this could probably trade a little bit lower. I know it's not exactly the same, but the German DAX added another 5% loss. And the FTSE 100, let's see if I can open that one. The FTSE 100 is not, again, it's not 100% clear, but this is actually definitely not, no, this is actually about correct. It's about another 33% loss here. So maybe your S&P 500 might add, if it adds another 5%, then we'll be trading down here. And if we just do a 3 and a 0.3 or something, we'll be down here. So it's a bit risky, but I think take this out, we'll spike a little bit lower, and then we'll see what happens. But the different strategies here, and maybe the better one is this. If it spikes below it, then on the way up, we look to sell again to target the lows. I think that's probably the better one. Because looking at this just like that, we can clearly see that we're on a downtrend. So I wouldn't get, you can always trade against and buy on dips. I did that very, very good on Friday actually. On Friday I had some very good returns. But it doesn't work out. Like effectively, whatever I made on Friday, I gave it back this morning trading the FTSE 100. I'm still up nicely on the year. But yeah, it's volatile. All right, let's see if you guys have any questions. And by the way, yeah, let's talk a bit about the coronavirus, right? So what's happening? What's happening? Okay, New York, LA, closing bars, cafes, and I think a few more things. Effectively, you can't go to those places anymore. You can go for takeaway, but that's it. So you can't do that. That's good. That's New York. That's LA. And as far as I understand, since Las Vegas is closing down its hotels, it's a good move. The America and South America are actually much faster at reacting than we're doing in Europe. Of why? Well, because we have experience from China, and we have experience from Italy, we have experience from Spain, and we also have experience from France and Germany. The only one that is not really acting very quickly is the UK right now. But yeah, so the closing down over there, they probably need to close down a bit more, effectively telling people to work from home, don't go out if you really don't have to. I think that's what's going to happen. And I think they're pushing something similar to that in France, and they also push something similar to that in Spain. But I suspect you might need slightly more restrictions. We'll see. I think people are going to watch what's going to happen with Italy. I think Italy now is in the focal point. If they can get the number of cases down by telling people not to go out and work from home and do what they do, then that could be a model for the rest of Europe. Now, in Italy, they closed down on Monday last week. That was the 8th. At that day, we had 1,247 new cases. Now, this has increased. And the reason for that is because people are home now, but people already got it. Remember, this is an infection you get, and then 2 weeks later you get hit. Something like that. It doesn't go quickly like that. So that is why this is taking time. And if we look at what happened in China, they closed down the doors when they had like 650 cases. They still had some 80,000 cases. Wow, from 600 to 8,000. So even if they closed the doors, that's where they landed. But it took about, if I can remember correctly, it took about 2 to 3 weeks after closing everything down. So we're just 1 week into the situation with Italy. Give it another 2 more weeks, and then we'll see what happens. If this starts to roll over, and it's all about the growth rate. Like if you look at what happened in China, they had aggressive growth rates, but then that diminished. So these are the daily cases, and you can see here how I think they closed on the 24th already or something like that. And then here on the 4th, that's when they had the highest, 4,000 new people. And then of course they added, but then eventually it tapered off. The same thing happened with the SARS epidemic. I have a webinar on this on the homepage here. You can just watch it, click on it, you watch the video, and you're good to go. So I think, oh, sorry, I dropped my microphone. So I think that is what we should be looking at that. Okay, so let's see here if we can answer a few questions. Nico saying hello to you. I hope you're doing well. I heard that they're shutting down in Greece. I think it's a good move, but I hope you're doing good. Everybody there as well. So the question is, why is the CAD outperforming the Aussie dollar so much in the last year? Is it justified, and can it continue? I think the number one reason for the Aussie dollar to weak, so the Aussie dollar is, because it's so linked to China. I think 50%, 38% or so goes to China directly. Then you have a bunch that goes via Hong Kong, and I think about 50% of all the exports that Australia has goes to China as well. Because of the proximities, there's a lot of other sort of there's a lot of Chinese people in Australia, and that as well, the tourism and a lot of the business just occurs on the back of that. It's gone now, and that's why I think, I want to say it's gone, but it's been hurt badly. And then I think that is why we're seeing the Aussie dollar so weak, and it's a clear case as well, because you can sell the Australian dollar, and that's like your proxy for shorting China. That's what people do. In the case of Canada has a higher correlation. Their GDP has a very nice and tight correlation with North America, and with the US, because they're neighbors, right? People do business with their neighbors mostly, and that is why it's not as affected as the Aussie dollar. And that is why. Will it continue? It depends, really. I think both the Canadian economy and the Australian economy are very competitive, and they're good economies. So I'm not actually sure exactly when this is gonna bounce back, but I reckon that, yeah, it's difficult. What does the chart say? So this is the Aussie dollar CAD, and this is an old analysis where we were trading within this rectangle. Market traded lower in February, went back into the rectangle, and then moved lower. And yes, I remember now. And this is the bigger rectangle within, from a purely technical perspective, from 2013 up until 2019, the market was trading sideways. And that's a big drop. The difference here is about 13%, or 12,534 pips. And the market is still heading for that target. So that is what you're looking at. And then from a longer term perspective, it's like a big range, right? So we're stuck in the upper end of the range, and maybe it would have pushed upwards, but it didn't. So now we have that, which is the bearish move. So maybe we'll down to $75 at one point. These big swings in the Aussie dollar are super common. And I'm sure the Aussie dollar is going to bounce back, but maybe that's going to happen from much low levels. So that at least is what the charts are telling us right now. So good morning, Maurizio. Hope you're doing good. And then we have Dwight Kelly. Good morning. I turned on a bit late. How am I doing? We should surprise. I'm doing good, thank you. And doing well given the circumstances. I'm happy that London, going to central London today, there's not so many people, which is good. More people are taking the right steps to protect themselves and their families, staying home. I'm gonna maybe and hopefully do that very soon as well. However, I'm wearing masks. I'm one of those guys. I bought my masks in January. So already for some time I've been using them. And I touch my face with these ones now. I don't touch my face anymore. Because you never know where your hands have been. Even though I think I put so much alcohol gel on my hands that, they get white because of the upper layer of the skin is gone. So I'm definitely taking precautions, and we'll see. I'm still a young person. Should be hopefully doing fine, but I'm doing good. So the question is, would I be surprised if oil goes down to 25? No, I would not be surprised if the market goes down to 25, because everybody right now is preparing themselves for a recession. They are very, very worried about the situation in the market. I think though, we're seeing the right steps by the government. if you want to wait a bit, which is probably a good idea, you would look for markets to roll over, looking for growth in places like Spain and France to roll over. It's not going to roll over soon. It's going to get worse. It's going to be similar like we saw in China. And then I think when we hit the peak, let's remove China. When we hit the peak, that's when people are going to be like, all right, things could be fixed. They were fixed in China. And people are saying, well, what's going to happen in China now when they let people go back and work again? Well, you're probably going to have a situation where you have the virus coming back again. However, some of these, they call them fever hospitals in China. So when you had signs of the virus, they would send you there. Some of them are closing down because they're not busy anymore. So at least, they took care of the first wave, so to speak. And the second wave can become worse because 80,000 people, I mean, they're like 1 billion. So you can easily have more. But this gives at least a bit of time to develop some sort of a vaccine. And then after, when this is over, I think we'll in 2 years' time, we're still probably going to talk about it a bit, but I don't think it's going to be a huge thing. But so what you want to look at the growth rate, and then you want to see how markets are reacting. Can they trade more lower? Of course they can. But I personally think this is an excellent opportunity for low leverage or no leverage strategies. Of course, what you do with your money is up to you. Yeah, we might add another % or two. This is the German DAX. So say we add another 20% just for the sake of it. We add another 20%. The market in the German DAX would be back at 2007 levels. So we need to ask ourselves realistically, has the world not improved in the last 13 years that the markets needs to go back to 2007 levels? That's how I would look at it. And of course, some people don't like their lives, but I can tell you I'm doing much better than I did in 2017. Money-wise. You go older, you get more bitter. Everybody knows that, right? I think about 50, or 45, I think you get the most, not 45, 50, that's when you're least happy. And then when you start to reach retirement, you start to get happy again. You can check that out. It's like a curve. Effectively, you're very happy when you're 20 because you don't care, right? Life is easy. Not for everyone, but in general, if you're living in the Western world. All right, let's see if I can find the S&P 500. I just want to show you some. I just want to explain. So, for example, we'll load the monthly chart. So, I found this similar situation, and I did buy. At that point, I didn't have a lot of money of my own, but I did help my parents, and we bought. We were bullish on the way up, and then we closed out. The whole market collapsed on 30% or so, and I bought here somewhere. So the way you're looking at it like this, when the market in 2009, when the S&P 500 reached this low, it was back same levels as 1996. I mean, that's so many years. And again, you can challenge yourself and say, has nothing happened here for 15 years to warrant the stock markets to be down at these levels? Of course the world has improved. And that was a very good time to buy. And then again, maybe if we just go down to 2017 levels in the S&P, it's not a biggie. But I still think, again, sort of longer term is interesting. And then I would just buy and buy and buy every month. That's what I would do, like in an ETF. And then you have your trading account with your favorite broker, and you trade the swings if you want to. Okay, so we're going to wrap things up. So we got a question here. How big is my trading account? My trading account is big. It's bigger than most people. It is. Is it huge? No. But I qualify for all the different benefits that you can get with the brokers. So yeah, it's a good size. And it used to be even bigger before. But then I bought a London flat, and very central. So that took a big dent out of my trading capital. Because London is pretty much one of the most expensive places in the world to buy property. But yeah, so it's a decent size. Now the size, everybody says size doesn't matter, and it's true. Size doesn't matter. You should trade with what you like to risk. So for some people, it's 1 month of pay, 2 months of pay, 6 months of pay. For some people, it's like 1 year's of savings. It really is up to you how much you want to risk. However, though, there's a bit of a risk if you trade too small. I think if you trade too small, that's when you start to take too much risk sometimes. Because sometimes people put $500, 1,000, and then they put a huge risk on that, and it's win and lose. That's probably not a good idea. When you start to trade, you need to trade. You need to take your money and you need to divide it at least in 10 equal pieces. Okay, maybe 20. So effectively, you risk 5% of your capital each time. That's if you're a longer term trader. If you're a shorter term trader, in and out, then you're probably maximum 1% per day, per trade and day, maybe 1.5. So okay, say two. Because if you have it really wrong and you trade for 5 days, you lose 2% each day, that's down 10%. That's quite a lot of percentage wise. So the question, how do you get there? So the question is, how do you get there? That's a very good question. So when it comes down to trading, I started with 2,000 euros in 2006. When I was a student, I did use some of my student loans actually to put money into my account. You can do that back then. And I traded with that for many years. And then when I started to feel more comfortable, I started to make some money. I took money from my salary effectively. So because I was working at the broker at the time, and I was putting that money into my trading account. Some of it, of course, you get your bonuses and stuff like that. So you add a few more thousand into the account, and then you trade with that. But there's also limitations, because I do know at one point I was trading with a significant amount of money, effectively with pretty much what I was making my whole year before tax. That's how big my account was. And it was good as long as you were making money. But as soon as you start to lose money with such a big an account, you're like, oh, wow, I just lost like 1 month of salary in 1 week or something. And then you start to say, oh, maybe I shouldn't be trading with that lot of money. And that's, everybody has their own sort of level. So again, start with a sum that you can work with. And then when you're comfortable, you can add more and more and more and more and more. Okay, we got a question about gold. That's true. I forgot about gold. All right, this is gold. This is your monthly chart. This is actually quite interesting from a monthly perspective. If you look at this from a monthly chart perspective, it's actually very bearish, this pattern here. This is like a reversal pattern, which effectively tells you we can go even lower. Looking at this today, you might remember last week I was short and bullish because the trend was short and bullish. I actually bought myself. So the last week we said, look to buy here in this little spot here. I bought myself very close to the low, and within 5 minutes I was stopped out of this market. And then I said, okay, enough for the week, and I didn't trade gold after that. Looking at this today, the trend is bearish below 5097.73, and we could probably go up a bit, but I think we can continue probably to trade a little bit lower. Personally, I'm not super comfortable having a view on this market right now, but I think as long as we're below 1597, we can go again a bit lower. I don't want to have a very strong view here because we took out this level, but looking at it from a bigger picture perspective, we're still creating these higher and higher lows, and this is a situation where the price could just shoot straight up, which is a big risk. So what you want to do, if you want to do anything, is maybe sell a bit, but you need to be selling at the highs at the corrective moves. Okay, we're going to wrap things up. I just want to say one thing. When I look at the markets, because not everybody's aware of this, because I put ideas out, right? And then you say, well, he's been telling me to sell at this level, and we haven't reached that level for 3-4 days. Okay, so this is my list. So I look at the Eurodollar, I look at all these different markets, and I put some little flags on them to sort of let me know what is interesting, and so I get an idea of what's happening. And then I put a bunch of alerts in the system. So I get alerts when something is happening. I am, however, always like a hawk looking at this, so I have a very good idea what's happening. And then, for example, I get a signal in dollars or African rand, then I will trade that. Maybe another day is the Russell 2000. Maybe one day is the Canadian stock market. Last time I traded that one was in 2018, I think it was, when the market collapsed here. No, here. When the market moved down here, I made some 10% on this slide. So I don't trade everything always. I have my preferred markets that I know better, but I do keep an eye on everything. Like, I keep an eye on the Taiwanese stock market, where we get a few signals in October 2019, more signals in December 2019, and then the whole thing collapsed. So the trick is analyze many markets every day. That's as well as a good way of becoming very good in what we're doing in trading. You don't have to trade all the markets, but just by analyzing, updating your levels. So you want to figure out what's my entry, what's my stop, what's my take profit. Figure those three out. You do your little analysis like I do, and then you do that every day for 6 months, even for 3 days, even for 3 weeks or 3 months. You'll see a huge difference. And the more and more and more you do it, the more and more and more you become in tune with the market. Now, the problem with the markets, though, is that the markets have bullish trends, bearish trends, and they have the high volatile trends. And then you have, when stock markets are in a bull market, in a bear market, which is again very similar, but you got what we call risk on, risk off. So we're now in a situation which is called risk off, when you have like the dollar yen tumbling, pound yen going down, everything with the yen just strengthening, right? And then stock markets are going down, commodities are going down, and then gold usually goes up at this time. So that's one state, and that's where we are right now. But that state is very different to the state we had just maybe 3-4 years ago, and it's definitely different to what we had most of 2019, because most of 2019 we had range bound markets. So what that meant that you can buy on dips. So you could buy here, you can buy here, you could buy here, you could buy here. Eventually, if you give it long enough time, you'll be fine, and you could sell here, sell here, sell here, sell here, sell here, and you'll be fine. But then this market started trending strongly, and now it just did a 180-degree turn, and now it's just plummeting. And that, unfortunately, you just need to live it through. You can, of course, go back, look at a bunch of different in the back. You can go back and sort of see what happened in the past to gain some of experience. The more research you do, the better. But nothing takes away if you just do analysis every day for yourself. You don't have to even trade. You don't have to show it to anyone. You just cover all the main markets every day, and then before you know it, you'll understand the markets much better. Okay, guys, it's 10:25 a.m. in London, so unfortunately I need to leave you guys because I have a few meetings lined up. Don't forget to check out this webinar if you want to. I did a recording of a webinar I did. As well, don't forget to subscribe or follow me on Twitter. I'm gonna host a special webinar on Wednesday. We'll talk more about this. Very similar to what we're doing, but it's a bit of a different settings, more time to answer questions, and I'll see if I can prepare a few slides. Okay, have a great day, guys, and I'll see you guys tomorrow. Don't forget to like the video, and don't forget to follow me on Twitter. Have a great day. Cheers.